Next question number 4C. Following is information about J's portfolio. Investment in shares of ABC Limited 200 lakhs. Investment in shares of XYZ Limited 200 lakhs again. Daily standard deviation of both the shares 1%. Coefficient of correlation between both the shares 0.30. Required. Determine the 10 days 99% VAR value at risk for Mr. J's portfolio. Given the Z score from normal table at 99% confidence level is 2.33. Show your calculations up to 4 decimal points. Now friends, in this question we have been provided that calculate VAR for 10 days. It means that say what is the maximum risk that the investor has, that value of the portfolio will reduce in 10 days. So over here we are required to do answer in this sequence. Again I would like to share with you that say similar to this a question that we did in Navkar, page number 194, third question, third chapter, risk management. So friends, over here what you are required to do, first of all you are required to make the calculation of the standard deviation of portfolio on daily basis. Then standard deviation of the portfolio for 10 days. And then lastly you are required to find VAR value at risk. So there are 3 steps in which you are required to do working. So how you will do working? Like working note number 1, calculation of variance of portfolio, in bracket I am writing on daily basis. It will be calculated like this. There are 2 securities in which investment is made. So it is variance of ABC plus variance of XYZ plus 2 into R into standard deviation of ABC into standard deviation of XYZ. We can see that so the 200 lakh rupees is the amount invested and the standard deviation is 1%. So it is 200 lakhs into 1% plus 200 lakhs into 1%. That comes to 2 lakhs. 2 into R is 0.3 into standard deviation. That is 200 lakhs into 1%. Standard deviation 200 lakhs into 1%. Now friends, over here importantly we require the variance. So we are required to make square over here. So over here 200 lakhs into 1%, that comes to 2 lakhs. Square of 2 lakhs, that is a huge figure, divided by 10 lakhs, I am converting that into million term. So it is 40,000 million plus same value. So I am writing over here 40,000 million. 2 into 0.3 into again 2 lakhs into again 2 lakhs divided by 10 lakhs. That comes to 24,000 million. Plus 40,000 plus 40,000, that comes to 1,04,000 million. Friends, this is what we understand is the variance. However, we are interested to know standard deviation. Standard deviation of the portfolio is very simple, under root of the variance. So what we will do, friends, we'll do under root of 10 lakhs into under root of 1,04,000. Friends, 1 million is equal to 10 lakhs. If at all you want to calculate under root of any value which is in million term, so what you can do, you can find under root of million, that is 1,000, multiplying with under root of 1,04,000. So it is 1,04,000, its under root multiplying with 1,000. That comes to 3,22,490.3 3099. Because friends, language of the question is clearly specifying, show your calculations up to 4 decimal points. So let us meet with this criteria also. This is the standard deviation on daily basis. So we understand that this is working note number 2. Working note number 3, calculation of standard deviation of portfolio for 10 days. It will be calculated as under root of the days multiplying with multiplying with the standard deviation on daily basis, which we already have calculated. 3,22,490.3099. So it is under root of 10 into 3,22,490.3099. 10 under root into 322,490.3099. And answer of that is 10,19,803.9026. Now the final answer comes. The final answer is calculation of VAR, value at risk. We know, friends, that we are required to find Z value. It is x minus x bar divided by standard deviation. Z value is given in the question 2.33. X minus x bar is indicating that what is the maximum reduction divided by standard deviation of the portfolio for 10 days. That is 10,19,803.9026. So we understand that x minus x bar is value at risk 10,19,803.9026 into 2.33. We know that when we see the Z table reading for 99%, it comes to 2.33, which ICI has already provided to us in the example. It is 23,76,143.0931. This is the way you are required to do this simple answer. Mr. X holds the following portfolio: securities ABC PSU bond, cost, dividend, market price beta, risk-free rate of return is 12. Calculate the following: the expected rate of return on his portfolio using Capm, average return on his portfolio, calculate up to 2 decimal points. Again, friends, students of Navkar will be very happy to see this question, because similar to this question we already have done it. Page number 103, question number 19. Let us see how to do this question. The first question says that calculate return, expected rate of return using Capm. As per Capm, the rate of return will be calculated as RF plus beta into RM minus RF. This is the formula to be applied for calculation of expected rate of return. RF is provided to us in the example. Beta is provided to us in the example. So in the formula only the RM is required. We will make simple assumption that whatever return that these securities have been able to generate together is the return on the market portfolio. So what will happen? I am just giving rough explanation. A, B, C and PSU bond will make the total 16,000, 20,000, 32,000, 68,000. We'll calculate that what is the total cost at the beginning of the period. Then dividend 1, 2, 3, 4, that dividend information is given, and MPS at the end of first year 16,400, 21,000 and so on. Value will be calculated, total value at the end of the year. Once you compute these values, Based on that, you will make the calculation of the return on the market portfolio. Return on the market portfolio will have simple formula D1 plus P1 minus P0 divided by P0 into 100. यानी सारी सिक्योरिटीज ने मिला के कितना डिविडेंड पे किया है उसका वैल्यू हम लोग यहाँ पे लिखेंगे. सारी सिक्योरिटीज का वैल्यू एट द एंड ऑफ द पीरियड कितना है उसका टोटल हम लोग यहाँ पे लिखेंगे. कॉस्ट एट द बिगिनिंग ऑफ द पीरियड क्या था वो वैल्यू हम लोग यहाँ पे लिखेंगे. Divided by P0 into 100, that is the way we'll make the calculation of the return on market portfolio. यानी सारी सिक्योरिटीज ने मिला के जो रिटर्न जनरेट किया उसको रिटर्न ऑन द मार्केट पोर्टफोलियो असाइन किया जाएगा. फिर ये सिंपल फॉर्मूला से हम लोग इंडिविजुअल सिक्योरिटी का एक्सपेक्टेड रेट ऑफ रिटर्न कैलकुलेट करेंगे. दैट इज द वे द फर्स्ट आंसर विल बी कैलकुलेटेड. सिर्फ दो वर्किंग नोट्स, पहला आरएम का और दूसरा विल मेक द कैलकुलेशन ऑफ द एक्सपेक्टेड रेट ऑफ रिटर्न बेस्ड ऑन सीएपीएम. सो फ्रेंड्स, हमारा फर्स्ट वर्किंग नोट होगा कैलकुलेशन ऑफ रिटर्न ऑन द मार्केट पोर्टफोलियो, दैट इज आरएम. सिक्योरिटी ए का कॉस्ट है 16,000 रुपए, बी 20,000, सी 32,000, पीएसयू बॉन्ड इज 68,000. So 16,000 plus 20,000 plus 32,000 plus 68,000. That comes to 1,36,000. Dividend is 1,600 rupees each for the first three securities, and for the last one it is 6,800. So that comes to total 11,600. P1 is 16,400. 21,000, 44,000 and 64,600. 16,400 plus 21,000 plus 44,000 plus 64,600, it comes to 1,46,000. So return on the market portfolio will be calculated as D1 plus P1 minus P0 divided by P0 into 100. Amount of dividend is 11,600 plus P1 is 1,46,000 minus P0 is 1,36,000 divided by 1,36,000 into 100 for getting answer in percentage term. So 11,600 plus 1,46,000 minus 1,36,000 divided by 1,36,000 into 100, it comes to 15.88%. Now once you have the RM also, then later on you just have to apply the formula of CAPM to find expected rate of return. So friends, expected rate of return will be RF plus beta into RM minus RF. RF is provided 12%. For security A, beta is 0.9, RM is 15.88, minus RF is 12. For the B security, it is 12 plus beta is 0.8, 15.88 minus 12 again. Then it is 12 plus beta is 0.6, 15.88 minus 12. For the last one, RF is 12, beta is 0.4, 15.88 minus 12. So we'll make the calculation of the expected rate of return in this way. This is 3.88 into 0.9 plus 12. The question is providing that you're required to make the calculation up to 2 decimal points. So it comes to 15.49%. So again this 3.88 into 0.8 plus 12, that comes to 15.10%. 3.88 into 0.6 plus 12, that comes to 14.33%. 3.88 into 0.4 plus 12, that comes to 13.55%. So student of Navkar will be able to get additional 8 marks. Second question is Calculate average rate of return on his portfolio. That is the question. Now friends, average rate of return is very simple. Average rate of return means calculation of return of the portfolio as if you have made equal investment in all the securities. So what will happen? It is return of A plus return of B plus return of C plus return of PSU bond divided by number of bonds. So it is 15.49 plus 15.10 plus 14.33 plus 13.55 whole divided by 4. So in that case it comes to 15.49 plus 15.1 plus 14.33 plus 13.55 divided by 4, it comes to 14.62%. Friends, you can even calculate the beta of the portfolio, and again you can apply this formula. Beta of the portfolio will be summation of this 4 divided by 4. 0.9 plus 0.8 plus 0.6 plus 0.4 divided by 4, it comes to 0.68. So using 0.68 beta, 0.68 into 3.88 plus 12, you'll be able to get the same answer again. So either of the way, you can calculate the simple answer. Question number 5b. TG Limited, a multinational company, is planning to set up a subsidiary company in India where hitherto it was exporting. In view of growing demand for its products and competition from other MNCs, the initial project cost consisting of plant and machinery, including installation, is estimated to be $500 million. The net working capital requirement are estimated at $100 million. The company follows straight line method of depreciation. Presently, the company is exporting 2 million units every year at a unit price of $100. Its variable cost per unit being $50. The Chief Financial Officer has estimated the following operating cost and other data in respect of proposed project. Variable operating cost will be $25 per unit of production. Additional cash fixed cost will be $40 million per annum. Production and sales capacity of the proposed project in India will be 5 million units. Expected useful life of the proposed plant is 5 years with no salvage value. Existing working capital investment for production and sale of 2 billion units through export was $20 million. Export of the product in the coming year will decrease to 1.5 million units in case the company does not open subsidiary company in India. In view of presence of competing MNCs that are in process of setting up their subsidiaries in India, applicable corporate income tax rate is 30%. Required rate of return for such project is 12%. Assume that there will be no variation in exchange rate of two countries. All profits will be repatriated and there will be no withholding tax. Estimate net present value of the proposed project in India. Present value interest factor at 12% for 5 years are as under. Year 1 to year 5 discounting factors have been given. Compute your working to 4 decimals. Page number 150, question number 84, chapter Forex. Yes, this is again a question from Navkar material which had been asked in examination. Of course, there are certain changes in the figures. However, overall the type of the question is absolutely the same. Let us see how to do this answer. In this question, we are required to take decision from a US company point of view that whether to go to India for doing business or not instead of exporting the goods from US to India. The question is providing that, say, you're required to decide from the US company point of view that what do you think? Is it viable to go to India for doing business by establishing a subsidiary instead of exporting the goods from US itself? So we can say that's a kind of incremental approach is required to be adopted for the purpose of decision making. So what we will do, friends, we will do working something like this. In step number 1, we will write the investment. Investment will be consisting of, I'm just explaining to you, investment will be consisting of $500 million for fixed asset and for working capital. We can see that so the working capital requirement is $100 million. However, at this point of time, we already have investment of $20 million. Means additional investment of $80 million is required to be made. So the total investment will be 580. 5 years of the life, so 500 divided by 5, that comes to 100 as the depreciation. And so on, we will be making calculation further for the purpose of calculation of the expected cash flows. Expected cash flows will be discounted in present value term for the purpose of calculation of NPV. Over here, one of the important point that you need to understand is, as we are adopting incremental approach, in a way that as we are going to establish our own subsidiary over there, so we will not be able to export the goods from here. So whatever the loss of contribution for the existing investment is required to be considered as opportunity cost. In future, what will happen? हम लोग वहीं पे बिजनेस करेंगे, तो यहाँ से एक्सपोर्ट करके जो हम लोग कमाते थे, in terms of the contribution loss is required to be considered as opportunity cost. We can see that so the question is providing the information about the selling price is $100 and variable cost is 50. यानी अभी हमारा contribution था 50 और हमको ऐसा दे रखा है कि जो अभी हम लोग 2 मिलियन यूनिट्स का सेल्स करते थे वो फ्यूचर में 1.5 मिलियन हो जाएगा if at all we do not establish a subsidiary over there. So what will happen? It is 100 minus 50, yani contribution is 50 multiplying with 1.5 million. So product of these two is the contribution loss that we will be having. Accordingly, we are required to make the calculation of the recurring cash flow, which will be used for the purpose of NPV calculation. So friends, the answer will be calculated like this. Working note number 1, calculation of investment. That is in the year 0. It is consisting of capital investment, that is an amount of $500 million, plus working capital investment. Working capital requirement is 100. However, we already have existing working capital investment of 20. So incremental investment is 80. So the investment will be $580 million. Working note number 2, calculation of depreciation. It is cost divided by number of years. So it is $500 million divided by 5 years. So that comes to $100 million per year. That is the way the depreciation will be calculated. Then calculation of recurring cash flow. This recurring cash flow will be received from first year to 5th year. In that we will start with the sales. Production and sales capacity of the proposed project in India will be 5 million units, and we make an assumption that पूरा का पूरा capacity use हो जाएगा. So it is 5 million into. Regarding selling price per unit, no revised information is given. So we'll assume it to be same, that is $100 per unit. So it is $500 million. Variable cost, again it is 5 million number of units into variable cost is 25. That comes to $125 million. Then cash fixed cost is given. Cash fixed cost is $40 million. Depreciation, which we already have calculated, it is $100 million. Importantly, loss of contribution from the existing business. We have been provided that, say, existing business is having selling price of 100 and variable cost of 50. So it is 100 minus 50 multiplying with, importantly, 1.5 million. That comes to 75 million. All this will be subtracted from revenue to find profit before taxes. So 500 minus 125 minus 40 minus 100 minus 75. That comes to 160. Income tax rate is provided to us at the rate of 30%. That comes to 48. So profit after taxes is 112. We know that the depreciation is a non-cash item, so it is added back. Depreciation 100. So CFAT is 212. So the recurring cash flow is $212 million. Lastly, calculation of NPV. In that, year 1 to year 5 and 5th year. Year 1 to year 5, we will receive the recurring cash flow. That is 212. Last year, we understand that there will be recovery of working capital. That is 80. It will be discounted at the rate of 12% and will calculate the present value for the purpose of NPV calculation. Friends, at the end of 5th year, you can see that the salvage value of the machinery is provided, fixed asset is 0, so there will be only working capital recovery. Now simply these future cash flows will be discounted in present value term. You can see that the factors have been provided to us. First year factor is 0.8929, last year factor is 0.5674. So 5 years factor summation is $3.6048. Last year discounting factor is 0.5674. So annuity factor into 212, that comes to 764.2176. Last year it is 80 into 0.5674. That comes to 45.3920. Total of both of them is present value cash inflow. So the total of that comes to 809.6096 less investment. Investment is required to be made of 580. So NPV will be calculated as difference of both of them, 229.6096. So friends, the simple decision will be the project should be accepted. Just be careful that they have provided computer working up to 4 decimals. So accordingly, we are required to compute the present value up to 4 decimals. Question number 5C. Discuss briefly the key decisions which falls within the scope of financial strategy. Friends, this is a question from chapter number 1, Financial Policy and Corporate Strategy. provided to you in the Navkar book. Question number 2, you can see, what are the key decisions including falling within the scope of financial strategy? And that is what you are supposed to answer. Financing decision, investment decision, dividend decision and portfolio decision. So again a question which students of Navkar can solve very easily. Question number 6a. Following are the risk and return estimates for two stocks. Stock A, stock B. Expected returns have been given, beta have been given. Specific standard deviation of expected return is given, 35 and 45%. The market index has a standard deviation of 25% and the risk-free rate on treasury bill is 6%. We are required to calculate. First question is standard deviation of expected return on A and B stock. Suppose a portfolio is constructed with a proportion of 25%, 40% and 35% in stock A, B and treasury bill respectively. What would be the expected return, standard deviation of expected return of the portfolio? That is a question. Now friends, this is a question of portfolio management. Similar to this, a question we have covered in Navkar book, page number 105, question number 25. The first question is, we are required to find standard deviation of expected returns of security A and security B. We know that the standard deviation is calculated as under root of variance. So we understand that the variance will be calculated as systematic risk plus unsystematic risk. Systematic risk will be calculated as beta square into sigma m square plus unsystematic risk. That is the way the total risk in form of variance will be calculated. It is required to be found for security A and security B. For security A, we can say it is 0.8 raised to 2 into standard deviation of M portfolio is 25. So the variance is 25 raised to 2. Unsystematic risk is provided to us in standard deviation term. So it is required to be converted into variance term. So over here, it is 0.8 square into square of 25. That comes to 400. Plus square of 35. That comes to 1225. So the variance of A is 1625. That is the way, first of all, variance can be calculated. Now friends, for B security, similar working will be made. For B security, systematic risk is 1.20 raised to 2 into variance of market portfolio is 25 raised to 2 plus unsystematic risk is 45 raised to 2. So it is 1.2 square into square of 25, that comes to 900, plus square of 45, that is 2025. So the total comes to 2925. This is the way, first of all, variance will be calculated and then standard deviation. Standard deviation is under root of variance for security A and for security B. For security A, it is under root of 1625 and for security B, it is under root of 2925. So under root of 2925 is 54.08% and under root of 1625 is 40.31%. That is the way answer of the first question, that is standard deviation of the individual stock, will be calculated. Second question is, suppose a portfolio is to be constructed with the proportion of 25%, 40% and 35% in stock A, B and treasury bill respectively. What would be the expected return, standard deviation of the expected return of the portfolio? Now friends, as far as the return is concerned, return is simple weighted average. So we have been provided with the proportion for A, B and C, that is A, B and treasury bill. Returns have also been provided to us, so we'll do the simple weighted average to compute return of the portfolio. For the purpose of calculation of the standard deviation of the portfolio, again we will compute first of all the variance, and under root of the variance will be standard deviation. That is the sequence in which we will do answer. Now friends, return of the portfolio will be calculated as simple weighted average. We have been provided, let's say, there are three securities in which investment is made. It is A, B and treasury bill. The proportion in which investment is made is 25%, 40% and 35%. Return of the individual security have been provided to us. It is 14%, it is 18% and for treasury bill it is 6%. So the weighted average will be like this: 0.14 into 0.25 into 14, that comes to 3.50. 0.40 into 18, that comes to 7.20. 0.35 into 6, that comes to 2.10. That is weight into return. Again it is weight into return. Then it is weight into return. That is the way the weighted average return will be calculated, and it comes to 12.8%. This is the way the return of the portfolio will be calculated. Now friends, the question is further providing that calculate the standard deviation of the expected return of the portfolio. Now standard deviation will be calculated as under root of the variance. So first of all, variance of the portfolio will be calculated, and to compute the variance of the portfolio, we are required to find unsystematic risk component of the portfolio. So what happens, let's say, calculation of standard deviation of the portfolio. In that case, what we will do, working note number 1, calculation of unsystematic risk of portfolio. Unsystematic risk component will be calculated. How it will be calculated? It is weight of A square into unsystematic risk of A plus weight of B square into unsystematic risk of B plus weight of treasury bill square into unsystematic risk of treasury bill. For A security, the weight is provided 0.25. Multiplying with unsystematic risk of A in variance term is 35 raised to 2. That is the specific standard deviation. For B security, similarly, it is 0.40 raised to 2. Multiplying with unsystematic risk is 45 raised to 2. Plus weight of treasury bill is 0.35 raised to 2 into unsystematic risk component will be 0. So we will have the working like this: 35 square into 0.25 into 0.25. That comes to 76.5625 plus 45 square into 0.4 into 0.4. That comes to 324 plus 0. So it is 76.5625 plus 324. That comes to 400.5625. This is unsystematic risk component of the portfolio. So once we compute unsystematic risk component of the portfolio, now we are required to find systematic risk component of the portfolio. And for that, say we will prepare the working note. Working note number 2, calculation of beta of the portfolio. Friends, beta of the portfolio will be calculated as simple weighted average. So it is weight of A into beta of A, weight of B into beta of B, weight of treasury bill into beta of treasury bill. Weight of A is 0.25, multiplying with beta of A is 0.80. Weight of B is 0.40, multiplying with, say its beta is 1.20. Weight of treasury bill is 0.35 and its beta is 0. So the weight of the individual security in the portfolio multiplying with the respective beta. That is the way beta of the portfolio will be calculated. So this is 0.20, this is 0.48 and that is 0. So that comes to 0.68. This is the beta of the portfolio. Now after calculating beta of the portfolio, we will make the calculation of the variance of portfolio. Variance of the portfolio is systematic risk plus unsystematic risk. Systematic risk is beta of the portfolio square into sigma m square plus unsystematic risk, which we already have calculated. Beta of the portfolio is 0.68 square into standard deviation of the market portfolio is given 25. So 25 raised to 2 plus unsystematic risk is 400.5625. So it is 0.68 square into square of 25. That comes to 289 friends plus 400.5625. So systematic risk plus unsystematic risk is total risk 689.5625. And last working note will be calculation of the standard deviation of portfolio. It is under root of the variance of the portfolio. Variance of the portfolio is 689.5625. So the standard deviation is 26.26%. So that is the way standard deviation of the portfolio will be calculated. Question number 6b. Mr. X, a financial analyst, intends to value the business of PQR Limited in terms of future cash generating capacity. He has projected the following after tax cash flows. Year 1 to year 5, cash flows have been provided in lakhs of rupees: 1760, 480, 640, 860, 1170. It is further estimated that beyond 5th year, cash flows will perpetuate at constant growth of 8% per annum, mainly on account of inflation. The perpetual cash flow is estimated 10,260 lakhs at the end of 5th year. Required. First question, what is the value of the firm in terms of expected future cash flows if the cost of capital of the firm is 20%? Second, the firm has outstanding debt of 3620 lakhs and cash balance of 2710 lakhs. Calculate the shareholders' value per share if number of outstanding shares is 151.50 lakhs. Third question, if the firm has received a takeover bid from XYZ Limited of rupees 225 per share, is it a good offer? Given present value interest factor at 20% for year 1 to year 5 have been provided to us. Friends, this is a question about the valuation based on expected future cash flows and a decision making about evaluation of a bid that we have received. In our chapter of mergers acquisitions, we are doing the valuation based on the expected free cash flows. So it is similar to a question that we do in mergers and acquisitions, question number 8G, page number 23. Coming to the question, over here we have been provided in the very first question that say you are required to do the valuation. What is the value of the firm? When it says value of the firm, it means that it is debt and equity both. In terms of expected future cash flows, it means that the future cash flows will be discounted in present value term. Year 1 to year 5 have been provided to us expressly. year 6 onwards for perpetuity, whatever you are going to receive have been discounted to the 5th year end. तो क्या होगा फ्रेंड्स, फर्स्ट ईयर, सेकेंड ईयर, थर्ड ईयर, फोर्थ ईयर, फिफ्थ ईयर, हर एक साल के इंडिविजुअल कैश फ्लोज को सबसे पहले हमको डिस्काउंट करना पड़ेगा. उसके बाद ये फिफ्थ ईयर के कैश फ्लो में हमको P5 ऐड करना पड़ेगा. P5 का मतलब क्या है, 6th ईयर ऑनवर्ड्स फॉर परपेचुइटी जो भी कैश फ्लो जनरेट होने वाला है उसका 5th ईयर का वैल्यू जो हमको दे रखा है 10,260 lakhs. तो इसको भी हम लोग ईयर 0 में डिस्काउंट करेंगे. प्रेजेंट वैल्यू ऑफ द फ्यूचर कैश फ्लो इज वैल्यूएशन ऑफ द फर्म. ये एक बार जो वैल्यू आ जाएगा दैट इज द फर्म वैल्यू. सेकेंड क्वेश्चन में हमको इक्विटी का वैल्यू पूछा है, वो कैसे करेंगे दैट वी आर डिस्कसिंग once we complete our first answer. Now friends, for the first question we are going to do calculation of value of the firm based on expected future cash flows for the first year, second year, third year, fourth year and fifth year. It is 1760, 480, 640, 860, and for the last year it will be 1170 plus 10260. That is the way fifth year cash flow will be calculated. Discounting factors have been provided to us in the example. Discounting factors are first year 0.833, second year it is 694, third year 579, next is 482 and last is 0.402. Cash flows into present value factor, total of that is value of the firm. That is our first question. Friends, all of you must understand that say the given cost of capital in the question must be weighted average cost of capital. So that is going to be used for the purpose of discounting cash flows of the firm. So over here year 1 to year 5 cash flows have been discounted, and this is the way value of the firm will be calculated. Now friends, second part of the question says that if the firm has outstanding debt of 3620 lakhs, cash and bank balance of 2710 lakhs, calculate the shareholders value per share if number of outstanding shares is 151.50 lakhs. So what happens at say in second part of the question, we are required to do working like this. Whatever value of the firm that we have calculated, from that debt value will be subtracted. So we'll get say the equity value. Now this is the present value of the future cash flow. So what we will do, so the current cash and bank will be added, divided by number of equity shares. Value of the firm is 7179.14 minus debt amount is provided as 3620 lakhs plus current cash and bank balance is 2710 lakh divided by number of equity shares are 151.50 lakhs. So it is 7179.14 minus 3620 plus 2710. That comes to 6269.14 lakhs divided by 151.50 lakhs. So with that, so the price per share will be 41.38. So it is 41.38 rupees per share is the value. Now, third question is providing that the firm has received a takeover bid from XYZ Limited of rupees 225 per share. Is it a good offer? That is the question. Now friends, in evaluating the third part of the question, we can say like this. We have like the valuation of equity share based on fundamental valuation method, that is based on expected cash flows. And this is 41.38 rupees per share. The offer price which is provided to us in the example is 225. 225 is exceeding 41.38. So from decision making point of view, we can say that it is a good offer for the company because 225 is exceeding 41.38. Question number 6C. State the main problems faced in securitization in India. Friends, again you can refer page number 200, question number 5. Explain problems in securitization. This is again the Navkar book. Stamp duty, taxation, accounting, lack of standardization, inadequate debt market, ineffective foreclosure laws. So these are the problems that we have in securitization in India. Again a question from Navkar book. Our question is, list the main objectives of international cash management. Now friends, this is a question related to the foreign exchange risk management. In your Navkar material, page number 160, cash management in MNCs. In that, this point is covered by way of theory, as well as question number 95 and 96 are the practical questions, again of this concept only. So we understand that the objective of the international cash management is to make sure if at all there is a requirement of the funds, then in that case the company is able to raise the funds at the most competitive rate. If at all there is an excess funds, then in that case it is invested at the best yield. If at all the company is having say more than one subsidiary, then in that case, if at all it is like the overseas, at one place there is a surplus, at another place say there is a shortfall, then in that case the funds arrangement have been managed in such a way so that say the overall the company is having say the best position. That is what say we understand is the kind of objective. So this is what a question from foreign exchange risk management chapter.